Hi, I'm Sarah Lacy, and welcome to the first edition of Ask a VC, where we take your questions and we grill some of the most powerful VCs in New York, Silicon Valley, anywhere we can find them. Kicking the series off is Fred Wilson of Union Square Ventures. Fred is an investor in Zynga, in Twitter, and what else are you in? In Etsy?
Etsy, Foursquare. Well, we got 35 portfolio companies, so there's a whole bunch of them.
Okay,
Want me
but
to name
those
them all?
those are the big trendy ones, the ones TechCrunch writes about every day, right?
Probably, yeah. We could figure that out if we wanted to.
Okay, great. So let's start it out with the question that most recently came into my inbox this morning. This is from Henry. He talks about a blog post you wrote earlier this week where you asked readers what they thought a contrarian web investor should be looking at right now. What is your current thinking on that? Did anyone say anything in the comments that made you think differently? And does this represent some kind of angst on your part of where your own investment thesis is going?
Well, most investors suffer from angst on a regular basis. So, yes, it definitely reflects some desire to come up with some new ideas that aren't on everybody's list. I'll tell you what I liked the most in the comment thread was this whole notion about sort of the anti-Apple, anti-New York, anti-Silicon Valley, focus on the middle class, focus on middle America, focus on people who have economic crises in their lives, focus on the average person, and do something, build something for them that can help them make their lives better, make their finances better, or make their job situation better, things like that. I thought that was an interesting contrarian investment, and I've been thinking a lot about that since that post, which was 2 or 3 days ago.
That's interesting. All right. I'm just going to try to roll through as many of these as we can rather than ask you follow-up questions. Okay, so this is from Peter. And a couple people asked this one. Do you believe that venture capital is still a home run business?
I do. I think that you can't deliver the kinds of returns to your investors that you need to deliver without at least one or two home runs in your portfolio. And so, I think we say that a third of the things we invest in won't work at all. A third of the things we'll invest in will work, but we wish we hadn't have made the investment. And only a third of them will produce any meaningful returns. And out of that third, it's one or two companies that will do way, way better than everyone else. So that's been my experience over the past 25 years in the venture business, and I really don't see that changing.
Okay, great. Now, since we're sort of tiptoeing around the super angel debate, I'll ask you one that came in about convertible debt. The subject line was, "Why do you hate convertible debt?" And I was like, "I don't hate convertible debt." Oh, this is for Fred. So this guy read your post and he really, he thought about it and he accepted that he thought you had some good points. But his question was, look, if I have a sophisticated investor who can value this company well, aren't there some fundamental advantages to this in terms of just getting the deal done faster, getting the money in the company, not having to deal with the legal fees?
Well, I don't think that there's forms of equity now that cost less than convertible debt. That's an old issue that's been solved. The reason I don't like convertible debt is if I'm going to take equity risk, I want equity returns. I want to know how much of the company I own for how much money the day that I write the check. And with convertible debt, you don't know that. It's TBD. And I don't want to get debt returns for equity risk. So I won't do it. Never have, and I hope I never will.
Okay, great. So now this is another question from Peter. He wants to know about venture capitalists utilizing wisdom of the crowds. Do you ever see some sort of crowdfunding model coming into your equity class?
It's already sort of happening in the angel market. So the way that that market works, the angels sort of follow each other. And that's obviously not crowds, right? That's not millions of people voting on these services. But you already do see that somewhat. We blog about a lot of things that we're thinking of investing in, maybe not by name, but we talk about the sector. We get a lot of input on my blog and my partner's blogs, so we're already doing some of that there. And then there's some interesting models out there that are taking it even further. A company here in New York called Kickstarter, for example, is doing that Diaspora, which is the open source Facebook, if you will, raised over $200,000 on Kickstarter. So there's definitely a number of things happening in the venture capital world that would lead you to believe that we're headed there.
Interesting. Okay, one last kind of big pie in the sky VC question, and then we'll get to some specifics. This is from William. He wants to know if you had one wish about the VC industry to be realized by the end of the year, what would it be?
That there were no assholes in it.
All right, we can't improve on that answer. All right, a couple questions about how venture capital works and advice for people raising money.
I might be one of them, by the way, so I'm not excluding myself.
It depends on the day that we catch you. Sometimes you are. Sometimes you're quite charming. Today's a charming day. That's probably because it's Friday. All right, Muhammed wants to know, how do VCs value a company? This is a perennial question, but I think it's really interesting in consumer internet right now, where we've really seen valuations like, for instance, in Foursquare, really kind of getting out of control.
So the answer to that is that the earlier stage the company is, the less it is science and the more it is art. There's been this rule for many years that in the first 3 or 4 months of the company's life, it can't be worth more than $1 million. In the first year of the company's life, it can't be worth more than $5 million. In the next years of the company's life, maybe it's worth $10 million. So there have just been these kind of, overall rules of thumb that have prevailed in the early stage venture business for companies that you can't value with real sort of fundamental analysis. As the companies get bigger, you use revenue multiples, you use earnings multiples. And we've used things like multiples of unique visitors, multiples of engaged users, multiples of other kinds of metrics that are available for these services to do it. But the bottom line is, when it's really, really young, it's pretty much just gut instinct and using some kind of rules of thumb that have been around for 3 or 4 decades.
Mm-hmm. Similar question from Robin. He wants to know how you know when something is a fad that will fizzle out or something that could become mainstream. Obvious sort of distinction here to me is between Twitter and chat roulette. How do you know Twitter is going to wind up being Twitter and chat roulette's maybe going to, you see a lot of naked guys and then people lose interest?
I think it's the founder. You look at Jack Dorsey and you look at Andre, and they just were different people who had different views of what they were building, and that'll tell you most of what you need to know.
Okay, great. Now, I had a ton of questions from people in other countries who talk about, that VCs like you place a lot of value on personal relationships, personal connections. You're finding a lot of deals through your own networks. If someone's in another country and they think they have a great idea, but they want to build something for their own domestic market, they don't want to move to Silicon Valley or New York, what's your advice to them?
Well, if you're building just for your domestic market, I hope your domestic market is going to be big enough to make it worth raising outside capital. And that's a big problem. I mean, even if you look at Israel, which has been a great venture capital sector for 20 years now, most of what they build are companies that focus on Europe and the U.S. and increasingly other larger markets. Their home market's not big enough to justify a venture investment. So the first thing I would say is, don't go raise venture money unless your company is going to serve a reasonable large market. Mm-hmm. And then the other thing I would point out is Seed Camp, which is started in London, is now operating in probably 10 countries around the world, South Africa and Turkey.
They're doing one in Singapore in October. They're getting into Asia now too.
Right. So Seed Camp is terrific, and they come to you. They do mini seed camps in Europe, increasingly in lots of countries around the world. Try to get into a seed camp program. Mm-hmm.
That's good advice. All right, so this is a little bit kind of nitty gritty, but I got a couple questions about when someone's raising funding, how do they calculate in the different costs of running the business, and how far do they look out? Whether it's the cost of data traffic, putting that into the model, whether it's I'm an entrepreneur and I want to take a paycheck, how much is it okay for me to ask? How do I work that into the funding? I mean, any rules of thumb there that you would give a new entrepreneur?
Well, first of all, get all the costs. Identify all the costs, because we know what it costs to operate a business. And if the entrepreneur comes in and they don't know what it's going to cost to operate the business, that's not a good sign. We know how much, roughly speaking, the server costs and the bandwidth costs are going to be for a business as it scales. We've seen that so many times now that if their numbers are wildly different than what we've seen, that will raise credibility questions for them. So get those right. Second thing is put everything in. Whatever it's going to cost, have it in there so that you are properly projecting what it's going to cost to run the business. In terms of founder salaries, I think what I would say is, they need to be market or slightly less than market, but nobody's expecting founders to work for nothing. So just do some homework and find out what a reasonable founder CEO gets paid in whatever region you're in, Silicon Valley or New York or Boulder, Colorado, or somewhere else, and put that in your plan. Don't go broke because you're afraid to pay yourself a salary. I wouldn't think that's, certainly once you've raised venture money, it's not unreasonable to pay yourself what you'd have to pay somebody else to do the same job.
Right. Well, and also, I mean, if someone is living on ramen noodles, they might be more apt to want to take an early exit rather than really build the company. If someone's building something for the long haul, they need to be, meeting their living expenses.
Absolutely. And I don't think there are any venture investors out there who would expect anything other than that.
Okay, great. We have just a few more questions about some of your specific companies you're invested in, and then we'll let you enjoy your beautiful Friday. First of all, with Twitter, James Bryant asks about why doesn't Twitter have an app fund similar to Kleiner Perkins' $200 million iPhone app fund? He notes that Twitter needs to invest in their ecosystem since the majority of their traffic still comes from their APIs. More developers are starting to look at Facebook as an alternative. Something you're worried about?
I think it's very difficult for Twitter or Facebook or anybody else to be investing in their ecosystem because they can't invest in every single one of those companies. And then all of a sudden they're like cherry picking and picking the best ones. Then they start picking winners, and that's not a good situation for them to be in. What Apple did was that they essentially gave Kleiner Perkins the platform to be the iPhone app developer. But we have a couple of iPhone-oriented companies that were not able to get Kleiner Perkins I-funded as investors. So, we had to go ahead and build those companies independently of Apple or Kleiner Perkins, and they've done very well without it. So I'm sort of negative on the whole category, to be honest. I think what Twitter needs to do is they need to figure out how to make it profitable for third-party developers to develop on their ecosystem by building out the promoted suite of advertising and monetization products. They need to be, even better than they are, and I think they're getting much better. They need to be even better at doing conferences and other sorts of education for app developers, and really invest in the ecosystem that way as opposed to making equity investments.
And this question comes from Sarah Lacy at TechCrunch. I just sneak one in there. Twitter is the only kind of big name, likely they're already a winner, consumer web startup out there that has not done one of these mega rounds from Elevation or DST or a player like that. Do they need to do one?
Well, they did the $100 million round at $1 billion valuation. Well,
Facebook has raised $850 million. Groupon has done huge rounds. Zynga has done huge rounds. Are they good on money for a while, or is there a story I should be digging around?
They're good on money for a while. They still have almost all of the round that they raised last year at this time in the bank. So certainly it's not the financial issues that would force that. I'm not a huge fan of raising money for raising money's sake. Sometimes I think companies raise money because they can, or because their competitors did, or because they think that they need to. You got to look at what you really need. If you need the money, raise the money. If you don't need the money, why take the dilution?
Right. Which brings us to Zynga, who's also raised a lot of money. Now, Chris wants to know, with your Zynga investment, what stage was Zynga at in terms of users and revenue? What were the determining factors that made you want to write a check? They were certainly a company that came out and surprised a lot of people, not only with how they took off, but the actual numbers and the financials.
Zynga was one of those things. I've been an investor in every one of Mark's companies since 1994, and I have a personal relationship with Mark. I love investing behind him. Some of his investments have been successful, some of them have not. But he's a special person. Those who know him well understand what I mean by that. And it was a bet on Mark. It wasn't a bet on, it was Mark plus games plus Facebook. And that was it.
Great. Well, we'll have to leave it at that. I apologize to anyone if we didn't get to your question. But you're going to come back next month and do another one, right?
Yeah, it's fun.
Okay. Awesome. Thank you so much. And we will see you next week with some other VC in the hot seat.